Hi, I'm Anthony Brister, founder of Brister Law Firm, where we help business owners and high net worth families protect what they've built. And if your estate is worth more than 7 million, the IRS is likely preparing to take a big chunk of it unless you take action. In this video, I'll break down the estate planning strategies that smart families are using right now to minimize estate tax, transfer wealth efficiently, and keep more family for generations to come. Because estate tax isn't just a number, it's a threat to your legacy. So let's talk about the reality most people are ignoring. As of right now, the federal estate tax exemption is just under 13.6 million per individual. That means if your estate is below that number, it may not trigger a federal estate tax, but here's the problem. That number is scheduled to be cut in half by 2026, dropping back down to around 7 million per person. And that change will expose thousands of new families, especially those with growing businesses, real estate portfolios, or high value investments. And the tax, well, it's up to 40% on everything above that threshold. That means your children or your heirs could be forced to fire sell assets just to pay the IRS unless you plan ahead. This just isn't about the numbers, it's about control, timing, and legacy. Here's the good news: there are tools and strategies that can completely eliminate or reduce estate tax liability, but only if you act early enough. Some of the most effective approaches include gifting strategies. You can gift up to $18,000 per year per recipient, tax-free, or make larger gifts using your lifetime exemption, which is just over that 13 million as of today. Gifts made now use up today's larger exemption amount before it shrinks. Then we've got irrevocable trust. These are the cornerstone of every advanced planning. Examples include ILITs, irrevocable life insurance trust, to keep life insurance proceeds out of your taxable estate. GRATs, grantor retained annuity trust, to pass appreciation on assets with little to no gift tax. Then we've got SLATs, which are spousal lifetime access trust, to transfer wealth while maintaining access for your spouse. We've also got some business planning techniques. If you own a company, you can use tools like buy-sell agreements. You can use valuation discounts for minority interest, family limited partnerships. All of these reduce the taxable value of your estate while keeping the business in the family. And don't overlook charitable planning, such as charitable remainder trust, CRTs. If philanthropy is part of your vision, each of these tools work best when integrated into a full estate and tax strategy and not in isolation. Here's why timing matters. If your estate is between 7 million and 13 million, you have a limited window through the end of 2025 to lock in the higher exemption amounts under current law. In other words, you can move assets out of your estate now at today's exemption level, and the IRS will not claw that back when the exemption drops. That's been confirmed, but waiting too long can put your estate in the danger zone. And the closer we get to 2026, the harder it is to execute complex planning efficiently, especially if valuations, trust structures, or family governance conversations are still involved. Think of 2025 as your opportunity year. After that, the door may close. If you spent a lifetime building wealth, don't let poor planning shrink what your family receives. Read the full blog below. It walks you through everything we've covered and gives you the planning framework you need to move forward confidently. And if you're ready to take the next step, talk to your estate planning team now or reach out to us at the Brister Law Firm. We specialize in helping high net worth families protect their wealth with tax smart, legally sound strategies. The sooner you act, the more you save, and the more importantly, you'll leave a legacy that's built to last.